Chapter 5: Financial Instruments and Financial Markets. So, a major part of a financial executive's job is to raise money. So, we've seen in Chapter 4 that as financial executives, we will have problems where we need cash sometimes. Sometimes we have too much cash. So, what alternatives and instruments do we have as this executive who can sell the claims of the company's cash flows to some creditor who's willing to give you cash if you are cash deficit, and sometimes you want to buy back your creditors or shares outstanding if you have cash surplus. So you're constantly trying to either take money from your creditors or you're using your money to pay back your creditors, right? And so what are some of the instruments? And depending on the type of your time frame, if it's less than a year, you use money markets. If it's greater than a year, you use capital markets. And these instruments that this executive uses to sell or buy from creditors and investors is called a financial security. It's a security is basically in old days there used to be a piece of paper which wrote down like, hey, this company owes this much money to this person as a regular interest paying coupon, and if it's a bond or a security that says, hey, this is a share. But now it's all done electronically. So there's an instrument like you have money in the bank, it's electronic. Similarly, you have equity or shares or bonds, they're all electronic into your brokerage account, right? And so your broker or your brokerage will help you trade these securities. And these instruments are this whole securities that are available, or these instruments that are available, are less regulated today. They less regulated in the sense that they are regulated by SEC, but they're regulated less in the types of securities that are available. So let's take a look at what are the types of securities that are available. You can do bonds, which is fixed claims. You can do equity, which is residual claims. Mixed, which is you can convert both bonds and equity into something like a convertible preferred share. And so you could have a fixed claim and a residual claim, or you could have a derivative. This is where the number of combinations of these things gets exponential almost, right? Because you have contingent claims, which is like, hey, if this happens, this situation happens, or the price of this share goes above this, then I have a claim on this contingent on this condition. So there are multiple variations. So there are multiple instruments available to trade in the market. So that is less regulated, the combination. But each of these are individually regulated by the Security and Exchange Commission in the United States. And similarly, all countries have some sort of a regulatory authority. India has SEBI, and so US has SEC and things like that, right? But there are four different categories, in a sense, four categories. Within, there are multiple subcategories, but four essential categories. So bonds is where if you issue a bond, you are telling to your bondholder that I will pay you fixed claims, meaning no matter how I do in the performance of my company, I'll give you fixed claims or fixed amount of money, which is a coupon rate. And if you borrow money as debt from banks, then again you have interest rate, fixed interest rate, saying, hey, I'll pay you this much interest rate for the money that you borrow. So these are fixed type of claims that are bonds. Equity is residual claims. Like once your bondholders are paid off, you have equity holders who have all the claim on the money that the company makes or the cash flow that the company makes. So bonds can come with like covenants, like rules around how much debt to equity you can have, preferred creditors, and what is the liquidation rights and collateral, the multiple issues. And bondholders are the first and primary holders of the cash flow of the company, because they are guaranteed fixed, and there's like seniorities within them as well. And you can even go as far as collateralizing a specific asset, saying, hey, this creditor will get claim to this specific asset, so it's a secured creditor on a collateral. So bonds can have a lot of variation. Similarly, equity is residual claims after bond owners and all of the rules are taken care of. Then you have residual claims. So you get all the upside if it goes well, but you get all the downside first, because bondholders will take away most of the money. They'll liquidate the company. They will, they'll take the claims first. They'll get to take the claims first. As a residual claims owner in equity, you get to control the board by voting rights. This is also changed by different types of companies who give voting rights, and some shares don't give voting rights. So some equities come with it, some don't. And mixed is like convertible preferred, where you have a fixed claim and you have an option to convert into a share and a preferred share, which also gives you residual claims. So convertible preferred, cumulative preferred. So convertible preferred, cumulative preferred, the difference is the board can decide to give dividends. And so the convertible preferred stock, they get dividends when it's issued or when it's declared. But the cumulative preferred will get cumulative dividends independent of whether it's issued or not. They'll regularly get preferred dividends. So there's like a combination. Let's not get into too much, but bonds, equity, mix, and derivative. Derivative is the most interesting one, which is contingent, saying, hey, if condition of certain price goes above this, then I get the right to buy this or sell this, right? So there are various types of instruments, and it's very important to know what instruments are, what are the pluses and minuses of each of these instruments. And so that helps you to pick the right instrument to raise cash or to get rid of your cash, right? You have to think of taxes and multiple ways to use the financial security, and to acquire this knowledge is pretty critical. Why? Because you need to know, like, hey, 65% of usage for funds actually comes from internal profit and depreciation. Bonds are a big source, like 35%. There's 11%. This doesn't add up to 100%, but roughly speaking, 30% corporate bonds, 10% loans from banks. But the smaller firms actually have a larger dependency on banks. So knowing this area is important. Why else would you want to know this? Because think about this. If you don't know these instruments, then you would not be able to take care of risks like currency exchange risk. You wouldn't know how much debt to take versus how much equity, because you could get into default if you don't pay your debt holders, and then that can lead you to bankruptcy, that can lead you to liquidation, and so you could be wiped out. So knowing all of this is important. If you don't know these instruments, then you may not use the right instrument, which is the most efficient instrument. So it's quite critical. So let's go through financial markets, and the very first one we'll look through in this instrument is the private equity financing. So depending on your risk and the nature of your company, the stage and growth of your company, the amount of capital that you need, if you're very small, starting off, private equity are the players who are willing to take high risks, and they'll give you amounts, but they're not like massive amounts. You can't raise like billions of dollars from private equity, typically. So venture capital with new ventures, they have like a pretty aggressive buy, fix, and sell attitude. So within 5 years, they want to get out of it. So they might not be able to fix all the companies, but the ones that they do have success, they are like 10 baggers, right? So they cover the cost. The partnerships that are set up in private equity and venture capital is such that they remove the difference between an owner and a manager. So it's almost tied to the hip. So difference is minimized. So the incentives are aligned much more. Pay for performance. It's very decisive in action. It moves quickly, and they get out after they are done with the EBITDA multiple that they expect, the improvement that they expect in terms of sales. Once they're done, they're out, right? So, but that's private equity. But at some point, you might even want to raise much more higher money to pay back all of your private equity owners, your original shareholders, and your growth is so rapid that you need large sums of money, then you go for IPO. It provides huge liquidity for existing owners, but also provides financing for growth. Remember, if you are cash deficit, which we covered in chapter 4, then you need a lot of money if you're growing really fast. And so you can raise money from ordinary people. You go to public markets. In that, the big role comes of an investment banker who you have to do a bake-off with them, which basically there's a lot of steps. You need to really have a really good investment banker who helps you with the underwriting and book building, which in a sense is building a syndicate, saying, hey, I have these many shares to sell, and it'll build a syndicate of sellers who will get a fixed price for that equity, and they can decide how much they will sell it for to the public market. But they have to get rid of those shares. That's their job. They'll help you with the road shows as part of book building. They'll help you with SEC registration. They'll help you make sure that you're legally covered and that you get the best price. There's so much that you need to do as part of equity finance through IPO that you really need an investment banker, right? Within IPOs, if you're already public and IPO'd, you can have multiple seasoned equity issues, placement, private placement, and multiple other ways to issue more equity. So more equity, more cash, you can have a source of cash through equity dilution. And depending on what your country of domicile is versus what your country of headquarters, where your headquarters is, you could be a European company in Japan and taking loan in Singaporean dollars or something like that, right? So now there are 3 different jurisdictions. So you do that complicated setup when you can borrow money cheaper from international market, let's say, and let's say your reserve requirement for the monetary authority is a lot of rules that you can circumvent by this setup. So there's various complications, but in a sense, IPOs is not easy, right? There's a lot of cost associated with it. On an average, convertible bonds 2.2% cost, bonds 3.8% cost, and equity goes from 7 to 11% cost. So that's the key message I want to drive out, because based on where and how you place your shares, it could be very costly, and you have to pay those investment bankers a certain fixed rate and a lot of that, right? So private equity, IPO, and switching topics now to efficient markets, because each of these instruments that you use through equity dilution, through private equity and others, the question comes to mind is, are the markets efficient? And academics believe that market professionals cannot really time the market, and that it's a loser's game to time the market. So the market's efficient, but I think it's a matter of perspective that we learned from this chapter, because a doctor who has no idea of the stock markets will find it efficient and say, hey, look, there's no difference between an underwriter of the investment banker and others and an undertaker, right? So that's a really good example in the book. We say, yeah, I have no idea. For them, it's efficient. But for most people, markets are, who understand the markets, let's say who is a stockbroker at the floor in NYSE and understands so much in depth, for them there's a degree of inefficiency. Why is market efficiency and efficiency important? Because the kind of offering that we use, kind of instrument that we use, or the kind of combination that we use, we say, hey, maybe this is better, maybe that's better. The costs are different for sure, but if we understand that, hey, markets are efficient, and if we believe that for us markets are efficient, then the choices will be different. So in a sense, market efficiency is when you believe that any new information that comes into the market is quickly priced in, meaning people buy and sell quickly based on new information. And so the collective judgment of all investors is factored in, then markets are efficient. But in developing countries, I think markets are inefficient. News information don't pass as quickly. People don't have access to the same information. We've seen even in the US, right? I feel due to behavioral finance concept that we can use, if markets were really efficient, then the financial crisis would have not happened, right? There were these ups and downs, and prices do deviate from the intrinsic value in a pretty big way. So I tend to believe that markets are inefficient, and there's a degree of inefficiency between the markets. And so if you can place yourselves to better understand, and if you have better tools to gather information, or if you have an advantage, if you can predict the market, if you understand where the industry is going, for you market is inefficient. But if you don't understand the market, then market is efficient. That means you should just be buying index funds if you're an investor yourself. Similarly, what decisions you make based on your complicated understanding of the market, you will use the right instrument. So we saw this as a weak form, which efficiency, which just factors in the past prices. Semi-strong form, market efficiencies, past prices plus public information, everything is factored in. Strong form, market efficiency, past prices, public information, and private information. So, but if you trade on public markets, you're already too late, because if you know just the public information, everyone else knows, right? But that again depends. We saw that people react to news differently. Things that are already disclosed in an annual newsletter from the company gets shared, like in case of Micron, in so many different ways, and then probably downgraded, but the company's already shared like the revenue forecasts and others. So there is these vagaries of markets. So you need to know as an executive, like, this level of inefficiency that exists in the market. And this graph is a really good one, right? It says that, hey, if there is a takeover of a company, then if the announcement date is this, the price already starts to go up. And on the announcement date, it shoots up significantly, right? And then it continues to go down, right? Meaning if you now trade at this point, all you can do is lose money. Maybe you can use this information to go opposite, meaning you actually short it so you can make money, right? If this is true. So time series, this is just the mean price index of shares of 161 target firms involved in successful tender offers or takeovers, right? So it's an average. But remember, averages are tricky. You can die, if you're a 6 feet tall person, you can die crossing a river, which is on an average 5 feet or 2 feet deep on an average. Even if you're a 6 feet tall person, you can die, because on an average, it just evens out. You could have a place where it's like 50 feet deep and you would die, right? So it's very important and tricky to not look at averages. But in a sense, over a long term, public information is very difficult to trade at. So it's an important lesson. So then what tools are available? This is the third section. So there are 3 sections in this chapter. First is different instruments. Second is market efficiency, and third is what are the ways to manage risks. There are multiple risks in the market, right? There's currency risks, because if you have, let's say, if you're a US company and have a huge German deliverable, meaning you have your parts coming in from Germany, or your sales coming in from Germany, then if you have your receivables from that, then you have a currency exchange ratio between US and Euro. So there's currency risk. How do you manage that? How do you manage interest risks if you have your huge portion of your debt with interest that you're paying, and that you're expecting to take on more debt, and now you have to pay higher interest. Commodity price risk. If you are commodity intensive in a commodity intensive business, if the price of crude oil goes up, or steel goes up, or copper goes up, and all of a sudden it becomes more and more harder. So how do you deal with all of this volatility that keeps changing, right? The prices keep changing. Are there any ways to handle those volatility? Because less volatility, better the returns, right? So it's very important to know these tools that are available, especially 2 specific one: futures market and options market, because the size of these markets are really huge. So that also warrants some sort of understanding, at least on a high level. Like, for example, the total value is $10 trillion in the United States, but the size of derivatives market, which is, a secondary market that bets on the real goods, is 583 trillion. So it's almost like 60 times bigger, meaning these markets are huge. So that can have a huge impact on the volatility. And if you make mistakes in this, it's very expensive. So you might be a profitable company, but now if you're trying to reduce risk and you trade into these futures and options to reduce your risk, let's say currency risk, if you make a mistake, it would be very expensive. You could go from profit-making company to loss-making company. It's a huge help if you can use this well to hedge. Meaning if you know you have those receivables from Germany and you want to fix that rate right now, independent of what the future dollar euro exchange rate is, you can actually use this for hedging. So knowing these is helpful. People use it also for speculation, right? Like you can have a huge leverage use up to speculate on currency risk, interest rate risk, commodity price risk, which I don't think anyone can really predict, but people speculate. So these tools are not just available for these three instruments, these three risks, but also like stock price. You can use futures and options on a given company or a given index. So that also is available. So let's see how you can do speculation, right? That's the first one. So using a forward contract. So I'll give you a simple example. Let's say today, €1 is the exchange rate is, to get €1 you have to give $1.50. Yeah. And that is called today's spot price because it's available right now. It's your price, spot price. It's denoted by S cap, right? Spot price. And let's say €1 is available at 150, and you know that you have receivables in euro, and in a 180-day forward-looking contract for €1 is available at $1.48, meaning a 180-day, after 180-day, if you want to buy this dollar right now, you can buy it at 148. But you know, for some reason, and that's the risk that, let's say you're trying to hedge against, or let's say you want to speculate, saying, hey, you speculate that the euro will become even more weaker. It'll go from 150 to 140. Right? So meaning you have to pay less dollars to get the same euro. So it's gotten weaker. And you think that the price is going to be 140 and not 148. So then what do? You speculate. So how you speculate? You sell 180-day forward contract today, right, at 148, right? Say, hey, I'm willing to sell this, right? And then what you do is after 180 days, you buy it at 140. Let's say, assume that it becomes at 140. So then you made 8 cents profit for every €1. So if you do it over a large amount, you can make a lot of money, right? By just trading on the futures contract. So that's speculation. But you can use this for hedging too. So let's say you know that same situation is going to get to 140, but you want to lock in at 148 because it's available. And it's a very small difference from what it is today at 150, and you think 148 is good enough for me. I just want to have regular sales and receivables. So what do? You say, hey, you do 2 trades. First, you buy the future contract, right, and at 180, and then you sell. So let's look at this one more time. So what you do now is, instead of just doing this one trade, right, you sell first and then you buy, and you made this profit in the previous one. What you do is you buy first, right? You pay that money, and then you get the difference, and then you sell. So you buy and sell. So what you do is, this is from the same previous equation above, right? This is the future price, spot price, and the amount that you bought and sold, and you sell at the future price as well, at the spot price, right? So what you do is you actually locking yourself in. If you add these two, you get 148 price today. So that's your lock-in. So you're saying, hey, look, even if it goes to 150, and if it stays at 150, I'm okay with 148. That's the risk that you're willing to take. But if it goes to 140, you still get 148. So you, with these 2 trades, where you buy the future 180 contract right now, and then you sell the future 180 contract right now. That's the difference. In the previous one, you sell first and then you buy after 180 days, right? Here you buy and sell on the same day, right? And so what you do is you say, hey, I'm locking myself to 148, even though I know today's price is 150. Great. So now you've hedged yourself to limited your losses. There are 2 ways in which you can lock in the price. We just did it with future contract. You can also do it with an option contract. This is too detailed of a topic, so completely skip through this. I'm also going to cover only maybe like 0.001% of this entire topic. I still fully don't understand it, but I have some idea reading this chapter. It's a really good chapter. So in options, you can do it with 2 ways. You can do a put option when you're long, meaning you're bullish, and you do a call option when you're short. So a put option is basically nothing but right to sell, right? Right to sell. And a call option is a right to buy, right? So basically with options, what you're doing is you're borrowing money. You sell now and then you buy the future price. So using future contract, you can do this hedging. You can also do it with options, with either a put option or a call option based on how you feel about the future. So let's make it concrete. So if you're long, if you feel the euro is going to weaken, right, and if you go long on it, you lose money, because if your strike price is this, then as the exchange rate gets stronger and stronger, you start losing money, right? Similarly, in a call option, if the exchange rate increases, then after your strike price, you actually start to make money, right? So meaning if the euro weakens, you make money with a call option, but you lose money with a put option. So one really interesting thing I learned from this chapter was that don't do this regularly, this futures contract. And if you are having a constant set of cash flows that are coming in, because sometimes you may be right, sometimes you may be wrong in terms of predicting the future. So it evens out. So you're not going to make money, really speaking, or not going to save yourself enough, hedge enough. But if it's a rare event where I'm going to have a huge downfall, windfall of money coming in, and I want to lock it in today, I don't care if it goes up and down, and I'm worried that it's going to go down for whatever reason, then yes, you use it once. Otherwise, on an average, if you have so many transactions, then this just evens out, is what the author says, which is pretty insightful. We know about this, that you can speculate, you can hedge, there are different types of doing it, futures and in options. Within options, there's put and call, right? And there's different types. So it's subject in itself, right? This what this chapter, it's in the appendix that we are going through all of this. It's a few pages, but there's a textbook written just for these instruments. But knowing this is important, at least on a high level, so that you know like how much leverage there exists, how much money you can lose, how much money you can gain, etc. Right? And there are tools that allow you to value an option. There are 5 key inputs to valuing an option, which is the current price of the underlying asset, the time to maturity, right? Strike price of the option, interest rate that is available, and volatility of the underlying asset. And there are tools available that gets you, like Robert's online option pricer that was given in the textbook. I was able to find that through Google. You can actually like value an option. How does this all help in real life, right? So first, as I said, every company goes through decisions like, hey, should we increase our production? Should we reduce our products mix? Should we get rid of these marginal products? Each of these is an option, and each options help us. If you can price them, then if you can attach a price to it, then you can find out like, hey, is it worth it, not worth it? Should I do it? Should I not do it? In each of this decision comes with a financial implication. So knowing that is very critical. If we know how to price an option, then we can use that for making the right technical decision or engineering decision or financial decision. So that was quite helpful for me. Hopefully this makes it slightly more easier for us to understand what are all of these instruments that are available. Market efficiency, behavioral finance. Each of this is like a chapter, book-worthy content in itself. So yeah, financial instruments, we got a little bit of a preview, and we understood about markets, and we looked at options and futures. Thanks.